This is a podcast from the Business Times.
The Dow Jones rose more than 1% to a record closing high yesterday ahead of the long holiday weekend as a softer-than-expected U.S. jobs report eased worries about interest rate hikes, while another sharp drop in chipmaker stocks weighed on the Nasdaq. The dollar fell sharply while the Japanese yen surged as traders braced for possible intervention by Japanese authorities. Asian markets have been anything but calm. They made a mixed start to the trading session today, and then commodities, gold and black gold, as it were. Well, you get the picture. What to do? Let's get help. Welcome back to Market Focus Weekly. I'm Howie Lim. It's Friday, July 3rd, 2026. I'm joined by Yap Fook Hien, Senior Investment Strategist at Standard Chartered Bank. Hello, Fook Hien.
Hi, Howie. Hi. Thanks for having me.
Oh, you're most welcome. Let's start with South Korea. Stocks in particular have seen sharp swings recently. Is this a sign that valuations have become stretched, or are the fundamentals still supportive of further gains?
Yeah, South Korea has been one of the best performing markets year to date. And funny enough, the valuations are actually okay or even low. But what's been happening is you've seen very significant earnings growth in Korea. We see more than 300% earnings growth this year, about 39% expected for next year. And because of the earnings growing so fast, if you look at a valuation measure like your PE, just because earnings is growing so fast, the valuation of the PE actually has fallen quite a lot. Now, in the last few months, it's been hovering around 7 to 8 times PE, but it recently fell below 6.5 times PE. So the valuation actually is low compared to your long-term average for Korea, which is about 9.8 times, nearly 10 times PE. A lot of it, I think, is the earnings that has been very strong, and that's why it's been driving the valuations lower. Question, of course, is will this stay on? Will the earnings growth continue to be strong? I think Korea is very much dominated by a memory chips industry, and the memory space earnings has been very significant, but a lot of it due to pricing gains, not so much units volume. We saw Q1 more than 70% pricing growth, but unit growth has been flat. Our view is that for the rest of the year, we see a soft landing for memory chip prices. And so we're still constructive on memory stocks and the memory industry. And we do see a soft landing for memory chips that's supportive of our core allocation towards Korea equities.
Let's stay in East Asia. Japan hit its 40-year low this week, the yen that is, fueled by a recent shift in expectations for U.S. interest rates, largely due to the war with Iran, and a rebound in the dollar. Also, the yen then suddenly surged yesterday as traders braced for possible intervention. Do you expect another round of that intervention? And how would that then impact your positioning in Japanese equities? Also for Asian investors, right? Is there a knock-on effect? Persistently weak yen?
Yeah, the question of intervention has been tricky. We previously thought that they could come in around 162, but then they weakened beyond. Then we thought they would. The last round, when they intervened, it didn't last very long. So we thought the policymakers might actually want to wait for more signs of a softer US inflation and softer labor market data before they could intervene. We thought that maybe 164 to 165 is a level they could look at. But obviously, overnight, as you said, non-farm payrolls came in weaker than expected. The yen has been stronger. We'll see how it evolves, but we think that the policymakers got 162 as a level, 164 to 165 as other levels. They are concerned about too much weakness in the yen, and we do see the rate hikes continue in Japan, which should be supportive. But at the same time, market is pricing in rate hikes for the US as well. And that has been what has been causing the differential. So we do actually expect the US rates to be flat, and we expect the US Fed to be actually cutting rate once next year. And so that will change the dynamics for the interest rate differential, leading potentially to a weaker yen over a 12-month outlook. Now, the impact on Japanese equities from the weaker yen, obviously that's great for the exporters. That's very supportive. Japan's economy is also very cyclical. We're taking a view that Japan equities is a core holding for us since the Takaichi government came in. A lot of fiscal plans, spending there, that's positive for the outlook. Reflating economy is good for Japanese corporates. They can raise prices. You can see a profit growth. We view Japan as core within our global equity allocation. For other Asian investors, well, for Asian travelers, it's good to have the weak yen. I think for Asian investors, having exposure to Japan makes sense. And given our view that the yen could be stronger, being a bit unhedged on the yen exposure there could also be positive tailwind.
What about China? Chinese equities have lagged many of their regional peers this year, despite various policy support measures. What's holding the market back, and what will it take to restore investor confidence?
Yeah, I mean, the Chinese market is very much policy driven as well. And, comparing to their regional peers, of course, you have markets like Taiwan and Korea, which are very, very heavy in the semiconductor industry. We've seen the AI capex boom really benefiting these upstream chip makers. That's been very supportive for the regional peers. So just, simply lacking those industries meant that China has been lagging these other markets. And then we saw very strong growth in Q1 for the Chinese economy. And as a result, fiscal spending actually went negative in April. So it's been a bit weaker. Yeah, I mean, recently, actually, especially since just the month of June, we've seen Chinese equities actually turning down, being a bit weaker. There's still concerns about deflation and weak consumer spending and how the expected policy stimulus is not coming yet. So I think the lack of these positive stimulus and positive boosters, if you like, that's been causing China to really underperform. We do like the market. A lot of the negativity is actually being priced in to the valuation. And to restore the investor confidence, I think you really do need to see a bit more policy measures picking up to be supportive. We're also in a bit of a vacuum now until we get the earnings season coming through. The US will start first, of course, and then when the Chinese companies report, we want to see a bit more signs about what they're doing with AI and whether they're able to monetize that. And the policymakers, of course, are being supportive, but we still want to see how the corporates roll it out. So with these more measures and the fiscal spending hopefully turning in the second half of the year, that should be supportive for Chinese equities. Hopefully that would then reverse the underperformance.
Speaking of investor confidence, or maybe the lack of, over in Indonesia, all this brouhaha following the MSCI warning of a potential downgrade to frontier market status. I mean, year to date, it's down 35%. That's quite a big number. What you reckon?
Yeah, I mean, I think a lot of the overseas non-Indonesian investors, they would follow Indonesia and they would track the MSCI index. And given the MSCI review of the status of Indonesia, that has been concerning. Now, this has been running for a few months, I think, since the start of the year. Indonesian authorities, they have reacted to what MSCI has said. They've implemented a lot of changes. Yeah, I mean, they're trying to tackle and address the issues that MSCI has raised, and MSCI will take a few more months to review it. Look, I mean, we really can't add much on how it will turn out and what MSCI's decision will be. We do get a lot of clients asking us what happens in a scenario if it does get downgraded to a frontier market. There are precedents in the past. Pakistan, when they were downgraded back in 2021 to a frontier status, the market had been weak then, but post downgrade that was implemented, the market then fell another 16% over 6 months and another 28% over 12 months. Now, Indonesia is a much larger market than Pakistan, obviously, and it has already been weak. How much of this is being priced in, we don't know. It's not clear as well whether Indonesia will actually be downgraded. Foreign investors, obviously, will be tracking the market, simply looking at the MSCI benchmark, what MSCI does to it.
Still to come, AI capex, also bubble concerns, also what's happening with oil and gold. Stay with us.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. It's Market Focus Weekly. We're speaking to Yap Fook Hien, who's a senior investment strategist at Standard Chartered Bank. Fook Hien, has the wave of large-scale debt financing by these mega tech companies to fund AI capex changed the views on US stocks, really?
Yeah, you're right. There's been more debt funding and some equity funding as well from these large mega cap tech companies in the US. It hasn't really changed our view. I think we are still constructive. Yes, in the short term, it is raising a bit of hiccups at the moment. We see the large hyperscalers, large internet and cloud platforms which are investing in the AI. Their free cash flows fell by about 20% in 2025 and expect it to fall some more in 2026. A lot of it driven by the significant increase in AI capex. But their balance sheets are still very, very strong. These big tech companies' debt ratios are very, very low. So not a concern at all. They now have to raise external financing instead of using internal cash flows to fund the capex. So it's a less ideal scenario. It is still healthy in terms of corporate finance and their ability to fund it. And a lot of the investments we think will result in better productivity. And the US also has exposure to a lot of the AI infrastructure and semiconductors, which will benefit, right, from this rise in AI capex. And as the adoption grows, AI monetization comes through, we believe this is going to be more supportive of earnings growth in the future.
What about bubble concerns? AI-linked tech stocks globally and across Asia as well have seen real heightened volatility in recent weeks. What's driving these? And do you see this as a short-term correction or maybe that sentiment toward AI trades beginning to shift?
Yeah, I mean, there are questions about bubble. I think we've been looking at the chart. We've been showing our clients as well that since the start of the year, if you compare it to the dot-com time when the market rose significantly, but earnings didn't really rise then. Compared to the current scenario, the market has been strong. You do see earnings rising along with the market. At least compared to the dot-com time, we believe that there's an earnings backing, a fundamental backing behind the rise in the market. So we do not really see a bubble at the moment. It has been wobbling, I think, since the start of June. Market has been a bit sideways. There's, of course, your headlines in the Middle East. There's been big IPOs happening. And then you see investors as a result, having to make space in their portfolio, so selling down, lightening out some positions to make way for the big IPOs. So the market has been a bit flat since the start of June. And from the AI perspective, I think, some concerns may be that the build rate for the data centers may not come through enough, and the power infrastructure may not be enough. And also, we had a big chip company reporting at the start of June, where then the results and the guidance was a bit softer than expected. Investor sentiment has been a bit softer, but we think this is short term. We do remain positive as we see AI adoption increasing. In the US industries, we see it about 20 to 25% right now in terms of the AI adoption rates. And that's quite a large increase. And as more industries adopt AI, we believe that that's actually positive for the productivity growth, and they'll be supportive for earnings to grow globally. We see the tech sector earnings growing about 70% this year, and then nearly 30% next year.
Mm. Okay, should we even talk about oil and gold, Hook Hien? I mean, so poor thing lah, the oil prices at a 4-month low, gold suffering its worst quarter in 13 years. What do you think?
Yeah, I think oil, we have a 3-month target for oil at $80. This is for the WTI. It has weakened more than we expect. We do think in the short term, there should be some demand coming in, at least from a lot of countries that have been drawing down on their reserves. We saw the significant drawdown in reserves since the Strait of Hormuz has been closed. We expect this demand to actually come back in. We think a lot of countries around the world will do their best, right, to replenish the reserves. So at the least, that should be a short-term demand. The flow through the Strait of Hormuz, of course, will take time to normalize. At the short-term 3-month oil for WTI at $80. Over 12 months, we see it coming back down to 70. That's because of more flows, more normalization of the flows through the Strait of Hormuz. And gold, we are bullish on gold. We do like gold,
Really?
especially.
So
Yes.
going up to
Oh,
what,
oh,
4,500, 5,000?
yeah, I mean, our 12-month target is 5,100. Our 3-month target, 4,750. Look, in the near term, there's been concerns about how yields and a strong dollar, that's a bit of a headwind for gold. We did see some central banks selling since the Middle East conflict started, but that has turned. I think central banks are back to buying, and over time, we expect that trend to continue. It's because of the diversification of their reserves. That trend started a few years ago. We expect that to continue, and that's actually positive for the demand for gold. So gold is something that we always tell our clients, it should be an important diversifier in the portfolio. And because of the demand from central banks diversifying their reserves, yeah, we are bullish on gold. We see it going to 5,001 over the next 12 months.
Well, thanks for joining us today, Fook Hien. You're giving us lots to think about.
Yeah, no, thanks very much for having me. Thanks, Howie.
That's it for this week's Market Focus Weekly. If you have questions or feedback, drop us a note at btpodcasts@sph.com.sg. Also, the latest, check out Lens on Daily, Monday morning at 10 a.m. Till next Friday, I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.